progress.
Thank you. Hello, everybody. Very good evening for today's session. As you can see, this is the last session as far as my topics are concerned. And today we are going to have a topic on something which is very, very significant. In the sense, why I say significance is it has huge ramifications, not only from a India standpoint, but even from a global standpoint, and especially what India did for this particular topic, as you can see in front of you, it's called the Equalization Levy. But as always, before I go ahead with Equalization Levy, just to give a small overview of what we did in the last class, where we largely looked into the double tax relief that is available, because we, in the earlier sessions, looked at the domestic tax law implications. And then, as we discussed, once you look at the domestic law, you eventually also have to look into tax treaty and why tax treaty was required, why you have to look at double taxation. We saw the fundamental need that, in order to promote cross-border trade, services, good, it is imperative that there is no double taxation. Of course, eventually we also saw the fact that it went into double non-taxation, etc. And India has also entered into one more treaty or convention called MLI. So therefore, what we had broadly looked into is the need for double taxation and how we eliminate, which was through the tax credit method, because India follows the to relieve the double taxation, gives a foreign tax credit. So we looked at how does that mechanism, and more specifically, the foreign tax is restricted to the average rate of tax in India vis-a-vis to the foreign tax. And then we also looked into the foreign tax credit rules, which comes as part of Rule 128, which clarifies as to what are foreign taxes, the form that you need to file. And we also looked into the other treaty-related aspects. For example, treaty being beneficial, you can choose whichever is beneficial to you. So therefore, we did look into largely from the domestic tax angle in terms of how a treaty functions. Because the scope for you at the exam level is not to go into the treaty and look at the treaty provisions, because India has almost 100 odd treaties. So very difficult from an exam standpoint to keep questioning, and for you also to remember all the treaties. That is not required, because today you get all the treaties available and you can always have a look at it. So the idea is basically at your level, what the examiner will want to know is how does a treaty function? What are the main characteristics and features of the treaty without getting into the nuances of it? Now, having said that, let's move on to the recap questions, which we normally do. So that way, just wanted to ensure that you're all up to speed, and probably good way to refresh your memory as well. Now, I want you to, try giving the answers as well, just as you've been doing all these sessions. Please give in your answers. On question number 1, double tax avoidance agreements are entered. The double tax avoidance agreements, or it is also called as tax treaties, they are entered for which of the following reasons? And all the tax treaties are bilaterally entered. So which means India with the other country. So what is a bilateral? What is happening? Easy example is today India-West Indies match is going on, which is a bilateral series. If it's a World Cup, then it's a kind of a multilateral series, because there are 2 or more countries participating. So similarly, in a bilateral agreement, it's between India and the other country. So countries bilaterally enter into tax treaties. So that's why there are some variations as well, because some country would want, these are negotiations. So there are some gives, then there are some takes. There's a give and take. Question number 1, they are entered for, answer is pretty straightforward, not only to eliminate double taxation, they are also entered, section 90 gives powers for the central government to enter treaties or agreements for double non-taxation as well, because over a period of time, thanks to advent of multinational enterprises and globalization, they've got lot of tax havens, thereby resulting in from avoiding double taxation to we have gone to a situation where we need to avoid double non-taxation, that is paying tax nowhere. So to avoid it, countries have also entered into treaties. We look into that. And exchange of information, collection record of taxes, all of the above. So it's pretty straightforward. The answer is all of these above. And these are specifically mentioned in Section 90 of the Income Tax Act. So 90 gives powers to central government to enter into for these purposes. Continuing with that, my second question is to eliminate double non-taxation. So when initially India entered, Section 90 was largely for avoiding double taxation. But then countries came together after the subprime crisis in 2009, the US subprime crisis leading to another depression, global depression. So the countries came together and then constituted the G20 with OECD, something called the base erosion profit shifting, to ensure that countries don't lose tax revenue because of tax avoidance and tax evasions. So as part of the BEPS, India signed which? So India signed a few years back, which of the convention? Is it multilateral instrument, climate convention, bilateral investment agreements, extradition treaty? Pretty straightforward answer, multilateral instrument. So here you can see it is a multilateral because this treaty was entered, the MLI was entered between, today it has around 90 countries. So as you can see, it is bilateral. This is similar to your WTO agreement. If you look at your WTO, there are 150 odd countries which have signed, which are part of the WTO, the trade agreement. So similar to it in MLA, you have standard set of provisions which exclusively focuses on tax avoidance and tax evasion mechanisms. So once countries sign that, the MLI will add along with the existing treaties. So this is like an addition to the existing bilateral tax treaties. So that way, this will become a watertight mechanism to ensure that countries, especially multinational enterprise, don't use tax havens or don't do treaty shopping to avoid taxation. So multilateral instrument is an addition to your bilateral tax treaties, with which this way a country can safeguard and ensure that there is no tax evasion. Because the entire objective that you need to keep into your mind is taxes should not be an influencing factor for making any investments. This is the fundamental principle of a tax policy. It's called the tax neutrality. The tax neutrality is tax should not, just because a country has a lesser tax, that should not be a factor for choosing investments. Choosing investments should be various other factors, infrastructure, availability of labor, rule of law, etc., etc. The idea is tax should not be a factor. So that's why countries are making efforts to ensure that tax should not be a reason for choosing an investment destination. So India signed multilateral instrument, which is part of the BEPS action plan, to ensure this is exclusively, specifically meant for tax avoidance and tax evasion. Now moving on, which of the following method is used to relieve or eliminate double taxation? Foreign tax credit, that is resident country giving tax credit for the foreign tax, or is it exemption from foreign income? Both foreign tax credit or exemption from foreign income? None of the above. Answer to this is both, because a country can either tax their foreign income and give the necessary tax credit to it, or completely exempt the foreign income. They don't even bring it into the residents' total income at all. The worldwide income, the foreign income is exempted. India does not follow this, but generally speaking, these are the two broad options that is available to relieve or eliminate double taxation. India follows the first one, foreign tax credit. India prefers to have a tax credit. That is, let me include it and then give you tax credit to the extent which is lower. That is your average rate of Indian tax. or the average rate of foreign tax, whichever is lower. To that extent, I'll give the foreign tax credit. Who provides for foreign tax credit? Again, very basic. The resident country of the taxpayer. Because in India, a tax resident is taxed on a worldwide basis. Section 5, scope of taxation. A resident is taxed on the worldwide income. So therefore, any taxes that he has suffered in foreign country, those foreign taxes, a resident will always be obliged to eliminate. So the obligation is on the resident state to eliminate double taxation. So answer to this will be 1. GAR provisions can override tax treaty. The GAR, as you know, it's an anti-avoidance provision available in Chapter 10B. Can GAR provisions override tax treaty? Is this statement valid? We did discuss about this. We did solve a problem specifically on this, wherein the question was, can an assessing officer invoke general anti-avoidance provision if he believes that the treaty arrangement is to avoid tax? So in that case, can I go over and above? Can my domestic act override treaty? Is that possible? Yes. Specifically, 90 subsection 2A gives in the legislation that GAR provisions can override tax treaty, even if the tax treaty is beneficial to the assessee. Still, GAR will override. 6th, assessee earning Indian income can choose either act or treaty provision, whichever is beneficial to it. Is the statement valid? Yes. We have discussed this quite a number of times. Section 90, subsection 2. You can choose act or treaty, whichever is beneficial to the assessee. Moving on to question number 7, the recap. In order to avail tax treaty benefit under Section 90, a non-resident must furnish which of the following? So what the legislation says in India is, it's not enough that you are a non-resident and thereby you can claim tax treaty. There are also additional conditions stipulated in Section 90, subsection 4 and 90, subsection 5. What are those? One is there, one of the aspect is before you. The non-resident must furnish the tax residency certificate. So answer to this question is 3. He must furnish tax residency certificate, and there are also additional information that he needs to file in Form 10F. So majorly tax residency certificate that he needs to get from his, wherever he is a resident, that look, I am a tax resident in the UAE, or if I am from USA, I am a tax resident of. You have to get that. So you have to approach, irrespective, wherever, if you're a non-resident, wherever you're a resident, you need to approach the tax administration and ask for the tax residency certificate. And they'll give you, say, Sudarshan is a tax resident of so-and-so. I'll have to produce this to the Indian who's going to be told my taxes or anything. Now, from tax treaty relief, we did at the fag end of the last session, looked into advance ruling. So the concept of advance ruling is basically to ensure there is tax certainty and clarity. So any non-resident entering into a transaction in India, tax is a cost for him and he needs to have a clarity. So advance ruling was introduced, authority for advance ruling, which was a quasi-independent judicial body. Very, very fantastic mechanism. Worked initially when it started, gave a lot of clarity to non-residents, especially India being an aggressive tax jurisdiction. It gave a clear as to, okay, an advance ruling was by an independent body. It had a retired Supreme Court judge. And there were some very, very good rulings that initially came from an authority for advance ruling. But with effect from 1st September 2021, the authority for advance ruling was abolished and the new concept was introduced called the Board for Advance Ruling, called the BAR, B-A-R. The Board for Advance Ruling consists of members from the income tax authorities themselves. So therefore, obviously, there may be potential conflict or issues will come. But anyway, they have to live with it. The BAR, you need to wait and watch as to how neutral is the BA. So BAR is more like your CIT appeals or your dispute resolution panel for transfer pricing in international tax. Dispute resolution panel under 144C. So the board for advanced ruling effective from 1st September 2021. So now in this particular question, a non-resident applicant sought to seek advanced ruling for a proposed transaction it has entered with the resident taxpayer. The board for advanced ruling rejected the application, citing that the transaction is for tax avoidance. Is it valid or not is the question. So when it applied for the ruling, the tax authority, the advanced rulings, the bar felt that the transaction looks very shady. It looks like it is for making tax avoidance. So therefore, I'm not going to take this application and I'm rejecting this application. Is it possible? Yes, possible. So an application can be withdrawn under the advanced ruling. So the following questions will not be admitted before the AAR. This will also hold good for BAR. It's the same even for BAR. If it's relating to a transaction which is designed prima facie for avoidance of income tax. So if the bar feels that this transaction is of avoidance of income tax, then it can wish to not give any ruling to it and say, I'm not going to admit the application. Now, this is very, very significant because what happened was in the later part of AAR, practically we had this issue. Many of the non-residents application were rejected on the basis that it is for avoidance of income tax, because all these avoidance of income tax are all very subjective matters. So therefore, you will always have this side or that side. And if you decided to see it in a very, it depends on which side of the coin or which side of the table you are in. So therefore, there will always be an issue. And nevertheless, you need to keep in mind that the board for advanced ruling can also deny an application, citing that it is for avoidance of tax. So to question number 8 specifically, the bar rejected the application, citing that the transaction is for tax avoidance. Is it valid or not? Yes, it is valid because it has the powers to not entertain an application if the bar is of the feeling that the BAR, the BAR, the Board for Advanced Ruling is of the opinion that the transaction is designed to avoid taxation. Quick few questions before we move on to today's session. Question number 9. A tax resident of India wishes to undertake transaction with another resident. Since the transaction is worth INR 80 crores, the tax resident wishes to apply for advanced ruling to seek clarity. Is he eligible to apply to the bar? So this is a question because when the advanced ruling was introduced, it was introduced for non-resident having transaction with resident, or a resident can apply if he's going to have a transaction with a non-resident. Then there were also a mechanism, say the department, the government can notify. So the government notified that a resident India, a tax resident India can also apply for a advanced ruling for transactions within India, provided the transaction value is above 100 crores. Or if it is less than 100 crores, then the tax resident should be a public sector unit. So any public sector unit can apply. If you're not a public sector unit and you are only a tax resident of India, then for transactions above 100 crores, you can apply for AAR. In this situation, it is assumed that the tax resident is not a public sector unit. And since the transaction is less than 100 crores, he is not eligible to apply to the advanced ruling. Another time aspect, the time limit within which, very important, time limit within which an advance ruling should be provided by the DAR, whether is it 3 months from the date of receipt of the application, whether is it 6 months, whether is it 9 months, whether it is 11 months. So if you know the answer, you can please key in the dash box. The time limit stipulated in the law. So this is the great or the selling proposition or the marquee feature of a advance ruling. The idea is it's not about me applying for a ruling and waiting for 10 years to get my ruling. What is the point? Advance. I need to know in advance before I enter into transaction. So therefore, when the advance ruling was conceptualized, the time limit was also stipulated in the legislation so as to ensure that the time limit is adhered to by the advance ruling, the authorities as well. So that way, the non-resident gets a time-bound clarity and he need not wait for ages. So the time given is 6 months from the date of receipt of the application by the BAR. The advance ruling should be pronounced. The last one, an assessee, a non-resident assessee who sought for advance ruling from BAR is not happy with the ruling because according to the non-resident, it feels that it is not taxable. Nevertheless, it went for an advance ruling just to ensure that his or its understanding, his or her or its understanding is right. But then to its surprise, it found out that the advance ruling gave a completely adverse view, saying the transaction is taxable. So the non-resident assessee is not happy with the advance ruling. What can it do? Can it go for appeal to ICAI, go on an appeal to C8 appeals? Should it go on appeal to the High Court? Should it go to appeal to the Supreme Court? The answer is it can go on an appeal to the High Court. So it can go to the High Court. So obviously, High Court, when you go to the High Court, it's only be substantial question of law. So on the transactional aspects, the High Court will not, the factual aspects, the High Court will not look into it. But if it's a legal related law aspect question, then definitely the High Court will answer it. Otherwise, there is no such mechanism available for the assessee to go to the ITAT here. The ITAT can only go to the assessee can, on a advance ruling, can only go to the High Court for an appeal. All right. So with this, we will step into today's session. But before I go into today's session, there's one aspect that we still have to look into it, which is the concept of permanent establishment. I know this is something which we've been discussing a lot, where I've already mentioned that the permanent establishment is akin to the concept of a business connection, which I've already seen, but P is more a tax treaty concept. So under the tax treaty in India, we've been using business connection. Nevertheless, treaty uses the term called permanent establishment. If you recollect, in business connection, it was very wide. That is, we saw various examples how a business connection can come into it. There has to be a real intimate transaction. We did look about dependent agents and all those things. Now, when it comes to P in tax treaty, so the concept of P is again fundamentally very, very similar to business connection. All you need to keep in mind that at the end of the day, sorry, there is. Just give me a second for this. Some issue with screen. The concept of P is All right. Anyway, as I have my screens coming up. Nevertheless, the point which I wanted to highlight is, once a P is established in the foreign country, which means I'm doing business in that country. So a foreign company generally, can have various mechanisms to do business with another country, in another country. So one way is to set up a subsidiary. The other way is to set up a foreign company. And we saw the other one way is also to have a agent who can do it. So the point is, the concept of business connection or a permanent establishment is there saying, look, if you are doing business in a country, then you need to pay appropriate taxes because you're using that country's resources, country's infrastructure. So you need to pay the fair share of taxes. Now, how to determine whether it is doing business in India or doing business with India? So therefore, the concept of permanent establishment in a tax treaty emerged. So what it says is, if you are having a permanent establishment, if you are having a fixed establishment, just like how you use in your GST, if you have an establishment in the other country, that means you're doing business in that country. So when you're doing business in that country, then you should also, whatever profits that you make, you have to pay taxes, because this is what a similar Indian company in India, a domestic company doing such, they pay their taxes. You should also do it. If you have a formal presence, if you have an establishment, pay the necessary taxes. So that's how the concept of permanent establishment came in. You have an active income and you're earning that active income from another country by being present there. And then in such a scenario, you're obligated to pay certain share of your profit. You may be a foreign company with profits in your home country, but if that profit is attributable to the operations that you have carried out in India, then pay the necessary taxes in India. India deserves it. India needs it because you have used India's infrastructure and other market benefits. India is a market, you use labor and all this. So when you're doing business in India, you should pay the taxes in India, which is what any other domestic companies also doing it. So this is the broad concept of P. How to identify whether I'm doing active business in India. How do I know that I'm doing business in India? The hallmark or the yardsticks is called the permanent establishment. So as you can see, the permanent establishment is also defined, even though it's a treaty concept, is also defined in the Income Tax Act in Section 92F 3A relating to transfer pricing, which says it includes it's an inclusive definition, includes a fixed place of business through which the business of the enterprise is wholly or partly carried on. So a foreign company having a PE means it has a fixed place of business in the source country in India, through which the foreign company's business is wholly or partly carried on. So therefore, as you can see in the PE definition, if a foreign company has a PE in India, then which means there has to be some portion of the profit that the foreign company makes has to be attributable to India. Now that's how this concept of permanent establishment came in. If you look at your study material, they would have given the concept of PE. So what the treaty essentially says is, the treaty defines what could be the potential permanent establishment. So if a foreign company, only a foreign company can have a PE, because we're not concerned about Indian company, because in Indian companies anyway is going to pay taxes in India. So a foreign company, if it has a P in India, then whatever profits it makes, which it normally shows only in its home country, in the foreign country, certain amount has to be attributable to the PE to in India. So India is saying in your overall profits, you should also pay some amount of tax in India because it is attributable to the PE in India because you're doing business in India. So what are those PEs? The treaty gives you some criteria and defines what could be PE. For example, a branch office is a permanent establishment. A foreign company having a branch office in India. Why should the foreign company have a branch? Which means it wants to do business in India. If a foreign company has an office in India, it can be a project office or representative office. A foreign company has a factory. If a foreign company even has a warehouse, you already saw this, warehouse for delivery. So which means you have a warehouse. That means you're planning to do business. So if you can see that there is a strong connection, nexus. If a foreign company has a sales outlet, foreign company has a workshop to do repairs or supply, whatever. A foreign company having a mine or a quarry or any other place for extract natural resources. A foreign company has even a place of management, which means it can come anytime, go anytime, at its disposal, basically. So these are broad indicators to show that a foreign company has a permanent establishment in India. So if that is established, then the concept is very simple. If a foreign company has, say, overall global profits of 100, and it also has a P in India, then India will say, hey, look, whatever is attributable to India, pay tax in it. So let's say 20 rupees is attributable to India in this 100 profit, then pay tax to that effect of 20 rupees in India. India deserves it because you have a P in India. You have an active business income, pay tax in India. So this is the concept of permanent establishment. Basically, ensuring that foreign companies pay their share of taxes for doing business in India. For doing business with India, we've already seen 916, 917 royalty FTS. So P is a very, very important concept. And in this globalization era, all the more very relevant when foreign companies are trying to do business in India. So P gives the right to source countries to ask for share of the profits that is attributable to India. So this is the major concept of a P. So now you would have seen, in fact, I also want to touch upon the Visakhapatnam Port Trust, very interesting judgment of the Andhra Pradesh High Court, a must read for all international tax aspirants. In order to identify whether a foreign company has a P in India, the judgment would have said, if the foreign company has a virtual projection, alter ego, virtual projection in the soil of another country, then you can say a permanent establishment exists. So when it says virtual projection, alter ego, so if you are able to see that there is a branch office, there is a warehouse, there is a workshop, so all these are indicators that clearly says that the foreign company has a P in India. So therefore, whatever profit it earns globally, to the extent that is attributable to India, it has to pay tax in India on that business in profit that it has made. So that's the concept of permanent establishment. Now, this is where I think it's a good time to get into today's topic, which is equalization levy. So if you notice, if you have observed, the concept of PE is a 100-year-old concept established in the early 20th century, talking about 1900s, even late 19th century, if I may say, wherein, in order to be present in another country, you set up a branch, warehouse. There is a fixed place. You would have seen the PE definition also includes a fixed place of business through which the foreign enterprise carries on its business. What becomes very interesting is today we are in a digital era, fourth industrial revolution. To give you one example, let me just go to, this is my, you can see a Google browser. Let's say I want to go to Tax Guru. To see some tax article. I'm using a Google Chrome, okay? Now you can see when I go to Tax Guru website, I have this ad coming in, which is get life insurance premium. There is coin DCX. I was looking to buy some smartwatches from Titan. Probably I was doing some research on crypto because the recent budget has come out with, you would have read in the newspaper on crypto. So I was trying to understand some implications. Now I'm going to ESPN Cricket Info to see scores. Now, there are some ads coming in. It says you predict. This will keep changing. Now, interestingly, if you can see now, just before the class started, I was looking just for the sake of the class. I was trying to browse T-shirts, buy T-shirts. I don't know if you observed the T-shirts coming in. Basically trying to read my whatever I have browsed. The same thing happens in your Facebook. If you have observed, you would have done something and then Facebook will. In fact, I was looking at some shoes as well. And you can see there's a shoe ad coming in, Iman sneakers. And there are obviously the smartwatches, which I was trying to find out to do some. So now, what I'm trying to drive here is, not that I was trying to search for a smartwatch or a shoe. The larger picture here is, Google, which does it, gets money. Google US. And Google US not even need to step into India to set up an office. Or Facebook need not come into India. I don't know how many of you have seen this Netflix documentary called The Social Dilemma. If you have not, you should do it as well. But of course, many of you would be familiar with how the likes of Facebook, Google operates. So, but if you're not, please have a look at The Social Dilemma. And of course, I already gave you one more recommendation called The Laundromat, which is about the Panama paper leak, which again, I believe you should watch as well. So I'm giving you a lot of binge-worthies, if I may say, tax-related Netflix stuff. Now, Social Dilemma basically tries to see how technology connects us, controls us, and how an algorithm is being used, where all we need to do is set up a Chrome browser or Facebook and then automatically detects and all those aspects. Now, what is very interesting is Google or Facebook does not need, unlike those days, to come to India to tap the Indian market. And Indian market is pretty big market because it's a young population which is glued to internet, social media. And again, thanks to the likes of Geo, many of us are half the time in the phone, browsing something or the other, which again opens up a huge market. And of course, COVID also helped. Anyway, long story short, you would have seen there is now no need for a permanent establishment. So if you recollect, the idea of permanent establishment itself is doing business in India. Now, you don't need to do that because all I can do is just set up an online, everything can be done through the massive technology. As a matter of fact, I do recollect we mentioned about this particular case, right florist. Now, this is a tipping point from an India standpoint. Now, what happened with the right florist was Right Florist is an online bouquet company. So when it was it started way back in 2007 or 8, when the time Facebook came in and Orkut was going out. So Right Florist, what you can do is I can just go to rightflorist.com, and then if I have my brother in Bombay or Delhi and his birthday is coming, I can just order a flower and that gets delivered to his place in Bombay. Now, Right Florist approached Yahoo. So you can see a lot of things happen. So they went Yahoo, and then said, look, Yahoo, I want you to advertise about Right Florist. So whenever people go to your Yahoo email, Right Florist should come bouquet, or whenever you are able to read saying anniversary, wishes, birthday, please ensure my ad pops up. So all people can do just click order and we will deliver it. So when Right Florist wanted to make this payment to Yahoo USA, the question was, how do you classify it? We had a Supreme Court judgment which said, if it is automated, then it cannot be technical services. There has to be a human element. In the case of all these online advertisements, which you also saw now, it all works in algorithm. There is no human that happens. It's based on my past browsing history, my data, whatever it has read, and what I've been searching for, it automatically pops up. And there is a secret mechanism, or there's a mechanism that goes where the online, the guys who wants to have advertisements, they will go bid for it. Anyway, it's a technical stuff, which I'm not concerned about, which I think that's not part of our code. But the point is, in the case of Yahoo or Google, where I need to add, or Facebook, there are algorithms that work. There is no human element. So these algorithms will automatically ensure captures, and then you get your advertisements. The Supreme Court at that point in time said, unless there is a human element, there's no technical services. Now, this is not a loyalty because I'm not getting right to use anything. I'm only just giving an advertisement to Yahoo, and Yahoo puts my Right Florist on the side, just like what you witnessed now. This is not a royalty. Is this a business income? Was the next question for Yahoo US. Now, in 2008-9, Yahoo, one of the only you can tax a foreign income only when it has a permanent establishment in India. That is what we've been seeing now. Only when there is a business connection, or under the tax treaty, there has to be a permanent establishment. It has to be have an office, branch, warehouse, etc., etc. Now, there is no permanent establishment for Yahoo US in India. So, therefore, nothing was taxable. And the Right Florist case, the Kolkata Tribunal, a very good judgment, rightly held through the principles at that point in time, saying there's no business income for Yahoo India because there's no permanent establishment. A business income can be taxed in India only when there is a permanent establishment. Since there is no permanent establishment, there is no need for any taxes in India. This is very significant because, as you can see, countries like India are badly affected. Why are they badly affected? Today, you see the market. The market today, Facebook, India is the largest user. And the internet population, you can understand. Today, the bargaining power is actually with India. India can say, hey, Facebook, do this, do that. Because if India bans Facebook, imagine what happens. We know what happens to TikTok and all these things. So there's a huge market India has. So any case, we are not getting the fair share of taxes because of the concept called permanent establishment. Now, as I mentioned to you, the concept of P is very outdated, 100 odd years. So we need to have a newer way of taxing mechanism. Now, you can understand there are a lot of politics involved in it as well. I'm not going into that. The politics is many of these top digital companies are Google, Amazon, Facebook, name them. They're all part Apple. They're all US based. So there's already their economic superpower. So they will not allow you to change. The companies will lobby because all the money they make, they pay taxes in US. So US is happy with it. Why would US want to partake the tax revenues with India? Because if there is a permanent establishment, and whatever profit Google makes, Facebook makes globally, they have to share certain percentage with India. And what is that percentage? The percentage will be huge because the main market is in India. And India has a huge market. So the demand in India is huge. So therefore, they will not want to share it. So there are politics also happening, going on. Globally, countries are coming together, try to solve it. Be that as it may. Now, what India did is, how do we then, that digital economy is becoming very, very cumbersome to tax, because in the digital world, in the digitalized world, you don't need to have a presence in the other country. Everything done digitally. I don't need to. Now, today, virtual class is a classic example. Let's assume for a moment I'm sitting in Chennai. If I had to travel to, say, Europe, I would have been in a position to handle these classes. There's no need for me to have come to Delhi or India to take the classes. So that's the power of digital economy and digitalization. Having said that, so what India tried to do is, India was the pioneer to do it. India went, even though there were discussions going on, hey, look, why not we bring something called a significant economic presence? That is, have a PE without a physical presence. I'll come to SEP because that is, if you remember in the first class, I had purposefully paused SEP so that I can do it with the Equalization Levy. So we'll touch upon SEP because India's legislation has a significant economic presence as a business connection. I'll come to that. The other way is to have a withholding tax or equalization levy. So India introduced equalization levy in 2016. And what is very interesting note is, it is not part of your Income Tax Act. It is part of your Finance Act. Very simple logic. You may wonder why it's not part of it. Is it not an income tax? What is that? Is it an indirect tax? Anyway, as a matter of fact, please understand, the Constitution doesn't distinguish between direct or indirect tax. It's only economists who prefers to do it. India is not bothered whether the Indian Constitution doesn't classify between a direct tax or indirect tax or a consumption tax. They don't say it's only the goods and services tax can be levied, service tax can be levied. It doesn't classify between direct and indirect. Having said that, the reason for India introducing equalization levy in the Finance Act is very simple. If they had introduced under the Income Tax Act, Section 90, subsection 2, income tax or treaty, whichever is beneficial. Please understand, the tax treaties have to be updated to include these kind of digital services. Only then they can be taxed. If the tax treaty does not have something, then I would have always taken a treaty benefit. I would say the treaty does not have such a clause. So therefore, it is not taxable under the treaty. Hence, I will take treaty benefit. So to avoid non-residents, that's why the term, if you see, they have not called equalization tax. They've called it as equalization levy. It's called equalization levy because India, it's a very smart move by India, very smart move in 2016, making a very strong statement. Enough is enough with you big guys. You've been making a lot of money from India. You have India's data, do everything, you make money, but you don't pay your taxes. This is unfair. So what India did is, in Finance Act 2000, through Finance Act 2016, Chapter 8 introduced Equalization Levy by virtue of Section 163 to 180 of the Finance Act 2016. Now, what is it? What is the scope? How much is tax? What is it? So the background what I've given so far is the idea is to tax these digital companies, the digital giants who don't have a P in India, and to ensure that they don't take advantage of the treaty networks, tax treaty network, because tax treaty networks don't have they're not updated. They're entered in 1980s, 1990s, especially with developed countries. So they don't have a specific clause. They will say, no, this is not a royalty. They will say, this is not a fees for technical services. Again, there is no business income because there is no P in India. And therefore, it is not taxable. Same like right florist case. So therefore, to avoid treaty benefit to be taken, India introduced it as part of a Finance Act and saying this has nothing to do with income tax. It has nothing to do with Income Tax Act, nothing to do with Section 90. It is coming as part of the Finance Act. Now, what does it say? So, equalization levy is chargeable at the rate of 6% on the amount of consideration for any specified services. This is applicable only to non-resident. So any non-resident where there is a consideration for any specified services, we are going to see what are those specified services. So for a non-resident, if he gets a consideration for any specified services, then in such a scenario, equalization levy will trigger. So this you can see in section 165. So basically, it says a non-resident who receives a consideration for any specified services from whom? If it comes from that is, a non-resident receives consideration for any specified services from a resident in India or a non-resident having a P in India. So therefore, any resident who makes payment to a non-resident for a specified services. Now, what are those specified services? The specified services are online advertisement, any provision for digital advertising space, or any other facility or service for the purpose of online advertisement, and includes any other service. So largely, the government is trying to target Google and Facebook here. So you would have seen already the online advertisement which I had shown you. So any non-resident getting payment, that is getting a consideration for providing a specified services to a resident or to a non-resident who has a P in India, then the equalization levy will be chargeable at the rate of 6% on the amount of consideration received. So let's take a situation. The Right Florist India makes a payment of INR 20 lakhs to Google USA. Then in such a scenario, Google USA is a non-resident and it is getting payment of 20 lakhs from Right Florist India, which is a resident. Then on that 20 lakhs, 6%. So this is your like your gross receipts, tax on your gross receipt, more like your turnover tax, like your GST. Gross receipts, 6% on gross receipts. So 6% on the amount of consideration is only applicable for non-residents. Please understand. The idea is to target only the non-residents here. Why only non-resident? Residents, very simple. You can always, global income, they're going to pay their taxes. You can always do assessment. Non-residents, the problem is like Google, they take advantage of the treaty network. How will you go tax them? How will you recover them? So therefore, government introduced equalization levy and said, if a non-resident gets consideration for providing services pertaining to online advertisement to an Indian resident, then equalization levy will be chargeable at the rate of 6% on the amount of consideration. Now you may ask a question. So how do you expect Google US to pay this 6%? What if they don't pay? So what the government did is, having expected this, the onus is on the payer to deduct equalization and remit, just like of your TDSs. I am an Indian company and I'm availing Google services for online advertisement. And whatever payment I make, say 20 lakhs, the example that I gave, on that 20 lakhs, 6% I will pay to the Indian government. The balance 94% should go to Google US. So the onus is on the payer to deduct equalization levy and remit. So before, just for small side note, India also created a committee to look into it before introducing EL. That committee gave the draft report of the committee had a lot of services, but finally when the equalization levy came, the specified services was largely into online advertisement. As you can see, online advertisement, any provision for digital advertising space or any other facility for the purpose of online advertisement, and includes any other services as may be notified. There have not been any notification. Now you may wonder, why only online advertisement? See, the idea of the government was, want to make a statement. India wanted to make a statement to the world saying, from India, huge demand. So therefore, it's not only the supply that matters, it's also the demand that matters. Both goes together. If there is no demand, there is no supply, and vice versa. So it both has to be respected. The demand is from India. So the foreign companies have to pay taxes, is what India's contention. So India wanted to make a statement, and India was the first country to introduce something called equalization levy and made a statement to the world that we are no more going to tolerate this tamasha from the foreign digital companies by not paying taxes. So this is more on that context where India wanted to make a statement. So that way, the idea was, parallelly, what was happening globally was countries were coming together to discuss how a permanent establishment or how taxes can be shared. So that discussions were going on. But that discussions never came to a conclusion. There was no proper solution that was coming. So therefore, India was getting restless. So therefore, India introduced this equalization levy and said, look, you guys come to a solution. If you're not going to come to a solution, then I'm going to take unilaterally, I'm going to take decision and start levying taxes. So therefore, this is how the concept of equalization levy came in. And any non-resident receives consideration for any specified services. The specified services are online advertisement or any provision or any other facility for the purpose of online advertisement. That is, if you are a non-resident and you are providing any provision for digital advertising space or any other facility or service for purpose of online advertisement, then, and you're getting payment from a resident in India, then the resident must deduct equalization levy of 6%. The rate is 6%. Remit to the government, balance pay to the non-resident service provider. So therefore, equalization levy in short is applicable for a non-resident only, for online advertisement services, and it is taxable at 6%. The levy is at 6%, and the resident payer must withhold taxes at 6%, pay to the Indian government, and balance 94%. Now, what will happen? Will the US company get 6% in their home country as foreign tax credit? Answer is not clear. Will US treat it as a income tax? Not clear. So, and India was not bothered. India was not bothered because I'm not concerned. I want 6%. Give it. You want credit, you want it, that's between you and your home country. So that way, India was trying to put a pressure on the home countries to come and negotiate to the negotiation table. So these were all strategies adopted by the Indian government to bring the digital players and their home countries to arrive at an amicable solution as to who will tax, how to tax, because India felt India is not getting its fair share of taxes, being a market economy where demand is. So this is how the concept of equalization levy came in, largely because in the modern day industrial revolution 4.0, there is no need for a permanent establishment. The concept of permanent establishment was getting archaic. The existing tax treaty permanent establishment was outdated. So this is why India introduced something called Equalization Levy under the Finance Act, not under the Income Tax Act, so that non-residents don't take any treaty benefit by virtue of Section 90, subsection 2 of the Income Tax Act. Now, just some aspects that you need to keep in your mind in equalization levy is, it is not applicable if the amount of consideration is only less than 1 lakh. So 1 lakh is a very small amount. But anyway, they say, okay, I'll give you a small threshold. 1 lakh, if it is 1 lakh, not taxable. And if it is a business to consumer transaction. So here they are targeting large digital companies. Large digital companies is what they target. You and me are not going to go do online advertisement. Indian businesses will engage Google to make. So they're looking at a B2B transactions where money is also there. If it is a B2C transaction, then equalization levy shall not be applicable. You can understand, very rarely you will come across a B2C transaction in online advertisement. If the non-resident has a P in India, and the consideration can be attributable to such P. This is very important. So let's assume in the example I gave, Google has a P in India. And if the consideration can be attributable to such P in India, then equalization levy is more that time. Because once you have a P in India, then it's always easy for the Indian government to go and ask the PE to pay 40% of taxes. The problem is, all these companies will say, I don't have a P in India. But if you are admitting that you have a P in India and it is attributable, then India doesn't want equalization levy because 6% is nothing. India wants a larger pie. You have a P, 40% net basis taxation. So therefore, they say equalization levy will not be applicable if the non-resident has a permanent establishment in India. So exceptions to equalization levy are, if the amount of consideration received is less than 1 lakh, there is no equalization levy. If it is a business to consumer transaction, no equalization levy. And if the non-resident who receives the consideration has a permanent establishment in India, then there is no equalization levy applicable. Now, you need to keep in mind that as I already mentioned to you, equalization levy should be deducted from the amount paid, and as you can see, just like how your TDS are, you need to deposit the equalization levy within so and so date, and then what if I don't remit the equalization levy? If you don't remit the equalization levy as a deductor, there is a problem because you will have to pay an interest, because the resident has to, similar to your TDS 201, so you would have to make a payment. And there is also one more clause you can look at in section 40. The payment will be disallowed under the Income Tax Act for the resident. So if a resident does not deduct equalization levy, then in such a situation, there is an issue. That is, apart from interest penalty, it will also have to disallow the expenses for not withholding the equalization levy. Now, just let's look at this example to better appreciate whatever we have discussed so far on equalization levy. ABC Limited, an Indian company, is carrying on the business of manufacture and sale of teak wood furniture under the brand name Pure Wood. In order to expand its overseas sales and exports, it launches a massive advertisement campaign of its products. For the purpose of online advertisement, it utilized the services of PQR Inc., a London-based company. During the previous year 21-22, the Indian company ABC Limited paid 5 lakhs to PQR Inc., PQR Incorporated, for such services. Discuss the tax or TDS implications of such payment and receipt in the hands of ABC Limited and PQR respectively. If 1, PQR Inc. has no P in India, 2, PQR has a P in India and the service is effectively connected to the P in India. So an Indian company is making a payment to a UK company for online advertisement. So let's take the first situation. PQR Inc. has no permanent establishment in India. So the London company does not have a permanent establishment in India. So first we need to see is this a specified services by a non-resident? Yes. This is pertaining to online advertisement by a UK company. So therefore, the charging provisions will attract. Section 165 will trigger. The next point is the amount less than 1 lakh? No. The amount is more than 1 lakh, which is 5 lakhs. So therefore, the equalization levy will be attracted on the 6% on the amount of consideration. The amount of consideration is 5 lakhs. So on 5 lakhs, 6%, the Indian company has to deduct. The Indian company has to deduct and make the balance payment to the UK company. So you look at this, Chapter 8 of the Finance Act. So basically whatever we have discussed is encapsulated here. Where PQR Inc. has no permanent establishment in India, equalization levy at 6% is chargeable. So therefore, it works out to 30,000. Non-deduction of equalization. Non-deduction of equalization levy would attract disallowance under section 40A 1B, 100% of the amount. So ABC Limited would have had to disallow the entire 5 lakhs had it not deducted equalization levy. Now, One other important point which I wanted to mention is Section 10, Clause 50. Now, what Section 10, Clause 50 says is, once the amount is taxed as equalization levy, then it becomes exempt under the Income Tax Act. So, once an equalization levy is triggered for PQ or INC, then the income tax authorities won't come and say you have to pay tax under the income tax also. So just to ensure that there is no double taxation, Section 10, Clause 50 specifically gives a benefit whereby if equalization levy is attracted to the non-resident, then in such a scenario, the said amount is exempt under the Income Tax Act. There is one small amendment to it recently. I'll come to it later with an appropriate example. But you need to understand 10 Clause 50's idea is once you are levied under the Equalization Levy, then you will not be taxed again under the Income Tax Act. Now let's go back to the second part of the question. The second part to the question says, what if the UK company has a P in India and the service is effectively connected to the P in India? So the UK company has a P in India and the service, the online advertisement service, is effectively connected to the P in India. So we saw this as well in the exclusion part. Equalization levy shall not be applicable if the non-resident service provider has a P in India and the consideration can be attributable to such PE. So since the non-resident has a P in India and it is attributable, equalization levy won't attract. Equalization levy won't attract. ABC Limited is not required because this is excluded as part of equalization levy because the non-resident service provider has a P in India. Since equalization levy is not attracted, exemption under Section 1050 would not be available. So 1050 says if you pay EL, no income tax. If you don't pay EL, there will be income tax. Now this is what the government wants. If you have a P in India, then it's easy for government to collect taxes because there's a permanent statement, and more importantly, they can collect at a higher rate as well, 40%, and you need to maintain your books of accounts, tax audit, transfer pricing, everything will come, and the government will have a control. So that is why permanent establishments of a foreign company are given exclusion from equalization levy. So therefore, from an Indian payer standpoint, service recipient standpoint, I don't need to do equalization levy. The question is, I may have to see then whether this payment will come under Section 195. Yes, it will come under 195 because there is a P in India. So the said sum is chargeable to tax in India. And accordingly, the Indian payer has to withhold tax under Section 195 of the Income Tax Act. This will come as part of your business income. So you'll be taxed, withholding has to be done at the highest rate. So this is the broad concept of equalization levy that you need to be aware about. A non-resident, again, you can just relate to Google's business model. A non-resident providing online advertisement services to a resident, then the resident has to, while making payment to the non-resident, deduct equalization levy at 6%. Failure will attract interest penalty and also disallowance. These are all rest of the things are very procedural. What is the form to be done? When should I file it? You can have a look at it in the material. Deduct 1,000 per day. Failure to furnish statement. So there is something like your TDS statement. You need to file your equalization levy statement as well. But what is the amount paid? What is the amount of equalization levy deducted? Now, the equalization levy does not stop here. There was a significant amendment in 2020. It's colloquially called the Equalization Levy 2.0. It took a bigger and wider avatar. And that is going to be the major part of today's discussion. Equalization Levy 1.0, very simple, online advertisement, 6%, the resident has to withhold. Equalization Levy 2.0, I mean, of course, 2.0 is colloquially used, but under Equalization Levy, what I mean by 2.0 is the scope and the mechanics have increased to other transactions as well. What I'm going to do is, it's 7:17. So let's take a 10 minutes break before we move to a new season or 2.0 or the second chapter, whatever you want to call, of equalization levy. I would prefer to go uninterrupted. So therefore, let's take a 10-minute biofresh break. Then we'll resume at 7:30 with equalization levy, continuing the major amendments or the significant expansion of equalization levy. So see you at 7:30. As you would have seen, the purpose of equalization levy, you can see from the screen. It's an excerpt I've taken from that social dilemma documentary. Facebook and other aspects, we don't even pay for Google services and other aspects. You can understand when we're not paying for the product, then we are the product. So what I mean by here is it's our data and our history or transactions are being monitored, surveyed, and then sold. So now before going to the break, we're looking at equalization levy 1.0, and then going to go to equalization levy 2.0, which is the expanded scope of equalization levy. But just again, kind of a recap. This particular question 1 and 2, also specifies why it is very difficult to tax digital economy. Of course, e-commerce we still use loosely. Today, it's no more electronic; it's become digital. So the advanced version of electronic. Explain the core reasons for difference between the digital transactions and the traditional business transactions, causing difficulty to tax the income of digital economy. The core reasons, as you can see, the core reasons for difference between digital transactions and traditional business transactions causing difficulty to tax are because of, we've already discussed, absence of national boundaries. There's no requirement of physical presence. So things are getting blurred, becoming more and more intangible. No requirement of physical presence of goods and no requirement of physical delivery in certain cases. Today we just buy subscriptions online, etc., etc. So since e-commerce transactions are completed in cyberspace, it is often not clear as to the place where the transaction is affected, and thereby causing difficulty in implementing source rule. So normally in a source rule, you can identify, yes, there's a PE here, there's an excess here, but in a digital thing, very difficult to identify where the transaction is affected. And it's going to get more interesting the days to come, especially with the likes of metaverse, cryptos, and going to come where it's getting more decentralized and anonymous, pseudonymous. So anyway, interesting times ahead. But the point is there are efforts being made to see how we can come to a taxing consensus. So having seen that online advertisements were covered and the residents have to withhold the tax at 6% for online advertisement, making payment to a non-resident. Equalization levy in Finance Act 2020 extended it further. That's why it's called Equalization Levy 2.0. Now, under the Equalization Levy 2.0, the idea is, you'd have heard about this acronym called the GAFA. Google, Amazon, Facebook, and Apple, supposed to be the leading digital company. So Google has been largely covered, but then a lot of these, as you'd have seen, the e-commerce operators are operating and having business in India. But if you see, the website will be maintained in Singapore, maintained outside India. So therefore, a lot of sales are happening through the digital means. Unlike the earlier days where sales were happening through physical means, here the sales are happening through digital means, and there were a lot of revenue being generated from India. For example, as a sale of data is one aspect. User. So therefore, there's a close nexus with the Indian market through the digital operation. So the government again realized we're not coming to any consensus here, but it's not only about Google. There are a lot of other digital transactions that's happening for which India is not getting. And by the time in 2020, we all know India is the number one, at least in terms of size, the registered internet users in India. And with the likes of Jio coming in, proliferating internet even in tier 2, tier 3 cities, today you can see the amount of digital economy or the e-commerce market. And a lot of foreign players are also getting benefited because they have capital and other aspects. So therefore, government decided, let's expand it. And I must say this, wide expansive. Very, we're going to see some situations. But I can tell you, it has been expanded significantly. We saw in the first leg in equalization levy, where it was non-residents, same continue. The target is the non-residents. The target is not residents, because resident e-commerce operators like a local Snapdeal, quite easy to do it because they have set up in India. So you can always find out. But what about the likes of, say, Amazon? The websites will be maintained from outside India in a server in Singapore. What happens in those situations? They use the platform is being used to make revenue in India. Uber, if you look, for example, one point in time, Uber drivers were directly paid from the bank account in Netherlands, and the money that we make payment goes directly to the foreign bank account. So therefore, an India office, Uber India, was only going and meeting the drivers too. I may be wrong, but whatever public knowledge I've seen, this is how the model used to work. So therefore, very little taxes were paid in India. So hence what happened was the government decided to expand the scope and came out with a new EL 2.0 with a different and a big avatar, which was again part of Finance Act 2016. So a new section was introduced, section 165. Earlier talked about online advertisement. Now 165A. Now 165A, which I will read out and which I've broken it for you. So 165A says, on and from the first day of April 2020, there shall be charged an equalization levy at the rate of 2%. So 165 still continues. That is for online advertisement, 6%. 165A, the expanded equalization levy scope. Here, the rate is at 2%. There shall be charged an equalization levy at the rate of 2% of the amount of consideration received by an e-commerce operator. So a non-resident e-commerce operator from e-commerce supply or services. So an e-commerce operator, he gets consideration. So who is an e-commerce operator? An e-commerce operator it is defined in 164 CA, the definitions. E-commerce operator is a person who owns, operates, or manages digital or electronic facility or platform. So first, who is an e-commerce operator? So any 2%, any consideration received by an e-commerce operator for e-commerce supply of services, then 2% equalization levy has to be borne. This is the one here. Chargeability of equalization levy on e-commerce supply of services. So equalization levy at 2% would be chargeable on the amount of consideration received or receivable by an e-commerce operator from e-commerce supply or services. It makes to certain specified persons. We will look at these persons. So basic fundamental components are, there should be an e-commerce operator and he should have received consideration from e-commerce supply or services made or provided or facilitated by the e-commerce operator to certain persons. Then in such a situation, equalization levy will be at 2%. Now first, let's look at who an e-commerce operator is. E-commerce operator is defined under section 164 CB, a non-resident who owns, operates, or manages digital or electronic facility or platform for online sale of goods or online provision of services or both. This one, a non-resident. So you can see they're targeting only non-resident e-commerce operators who owns, operates or manages digital or electronic facility or a platform for online sale of goods or online provision of services. It can not only goods, it can also be for provision of services or both. So there has to be a digital platform, mainly a website. Take Amazon. This is a non-resident, Amazon US for a moment. It manages or owns a digital website platform facility for online sale of goods or online services. Now, so an e-commerce operator is a person, a non-resident who operates, manages or an electronic facility. And it is to be, consideration is received for what? Should be for e-commerce supply or services. So an e-commerce operator getting consideration for e-commerce supply or services. You can see the word supply. These are all GST terms. Supply or services. What is an e-commerce supply or services? So if the non-resident e-commerce operator, if he does any e-commerce supply or services, what is the e-commerce supply or services? That is defined under 164 CB of the Finance Act, which is any online sale of goods owned by the e-commerce operator, online provision of services provided by the e-commerce operator, or online sale of goods or provision of services or both facilitated. So the e-commerce operator can have his own goods sold. So let's assume I'm an e-commerce operator and I have a platform where people come and buy my own goods. Let's take Adidas, Germany. So I'm Adidas, Germany. I have a platform called adidas.com and I have all my Adidas shoes that are owned by me. People come and buy and I deliver it. So this is online sale of goods owned by e-commerce operator. E-commerce operator should be non-resident. Please keep that in mind. Or online provision of services provided by e-commerce operator. Example. One example I can think about is, let's take Coursera. Coursera gives you classes to do knowledge platform, where you can just train, read your courses, do courses. They are basically providing services through online. Let's assume Coursera is a non-resident who has a website or facility, Coursera or equivalent of it. And not only that, I don't even need to own the goods. I don't even need to provide the services. It is enough even if I facilitate them. So I can be a marketplace. For example, I can be eBay, a non-resident platform where people just come and sell goods. So I'm only facilitating. I'm a marketplace provider. I don't own goods. I'm a marketplace. So in that sense, like Amazon is a marketplace. So I facilitate online sale of goods and provision of services or both. Then it is which means I'm doing e-commerce supply of services. And the last point, any combination of activities listed in 1, 2, or 3 above. So combination of sale of goods, combination of services, or only sale of goods. So you can see it's a very wide, what is a goods, huge, a lot of definition. Provision of services is very expansive. And I don't even need to do anything. It's enough even if I facilitate. If I facilitate as well, that would be enough. Finance Act 2021 also has an amendment to it. They gave an explanation. I'll come to the explanation later, but you can have a look at this. The point is, you should be a non-resident e-commerce operator. A non-resident e-commerce operator is a person who owns, operates, or manages a digital electronic facility or a platform. And consideration should be received for rendering e-commerce supply or services. What is e-commerce supply or services? Very wide. Online sale of goods owned by the operator, online provision of services by the e-commerce operator, online sale of goods or provision services facilitated, and any combination of the activities. If this is done, that is, I become an e-commerce operator and I provide e-commerce supply services, and I get consideration from certain specified persons. Obviously, who are those persons? One, a person resident in India goes without saying. So if I'm doing these services which are being obtained by a person resident in India, then Equalization Levy 2.0 will apply, which means on the consideration, I have to pay 2%. Now, what you need to keep into your mind is Equalization Levy at 2% would be chargeable. Now, that's a slight difference in the mechanics. What I mean by it is, in the first Equalization Levy 1.0, that is for online advertisement, 6% has to be withheld by the resident service recipient. I'll withhold if I'm a resident and I've taken Google for online advertisement, I'll have to tell. But in Equalization Levy 2.0, the onus is on the non-resident to directly pay 2%. Resident need not withhold any taxes. The non-resident himself will have to comply with Equalization Levy, that is 2%. This is in line with the reason for they doing is because anyway under the GST regulations also, there are certain conditions stipulated. So they thought any non-resident will obviously try to get GST registration and other aspects. Even otherwise, they didn't want to burden the residents. So therefore, the onus is on the non-resident e-commerce operator who is rendering e-commerce supply or services for which consideration is received. Then in such scenario, it is the duty of the non-resident e-commerce operator to pay the Equalization Levy. There is no need for any withholding of taxes, unlike Equalization Levy 1.0. We have seen the scope, what is an e-commerce supply or services. Now, let's try to go further and see who are all the people who would have to, for whom it is not only the residents, even if I provide these services to a non-resident also. So we will look at these examples or the questions to better understand. This way you'll be in a position to relate. Now let's look at the first question. XYZ Inc. operates a website and is based out of the US. So XYZ Inc. operates a website and is based out of the US. XYZ Incorporated does not own the website. XYZ Inc. does not own the website. It only operates the website. Does not own this website. It only manages and operates the website. The website facilitates in online sale of children toys. So the website facilitates in online sale of children toys. During the year 21-22, sales amounting to INR 5 crores were made by selling the toys to persons who are resident in India. Determine whether EL will attract for XYZ Inc. So this is a US company which operates a website. The question is also very specific that it only manages, it doesn't own. So first thing we need to check is whether XYZ is an e-commerce operator. So if you recollect, for being an e-commerce operator, e-commerce operator is defined under section 164. See, a non-resident who owns, operates or manages. So I need not own. Even if I operate or manage, it is enough. So therefore, and who operates, manages digital or electronic facility or platform. So coming back to this question, it manages and operates, and there is a website. So there is a digital platform there. So therefore, XYZ is whether XYZ is operator, yes. So it satisfies 164C. Now, the website facilitates in next question that will come is, having seen that it is an e-commerce operator, whether it gets its obviously there is a consideration, whether it gets its consideration from e-commerce supply or services. So for e-commerce supply or services, again, very, very widely worded. And there should be online sale of goods owned by XYZ. Even if it's not owned, as long as it's facilitate also, it will become an e-commerce supply or services. So there is children toy. So therefore, it is a clear case of e-commerce supply or services. The question doesn't say whether it owns the toys, but doesn't matter. It looks like it facilitates. And recipient. Who is the recipient? The recipient is persons who are some issue with the system. Persons who are resident in India. So the section 165A, which is the charging provision, it says any consideration received from e-commerce supply services made or provided or facilitated by the e-commerce operator to a person resident in India. So it is very clear that the question clearly specifies that to a person resident in India, then resident in India, satisfied. So therefore, all the major conditions for levying is satisfied, because look at section 165A. It says the non-resident e-commerce operator should have received consideration for providing e-commerce supply or services to a recipient in India. And the question also says to persons who are resident in India. So equalization levy will get attracted on the 5 crores consideration at 2%. So therefore, 2% of the 5 crores, 5 lakhs, will have to be paid as equalization levy by XYZ INC. Is liable for for an equalization levy. So first question we are done. So it's very clear, e-commerce operator. So I need to see whether I'm an e-commerce operator. I should be a non-resident e-commerce operator. Whether I'm getting consideration for providing e-commerce supply or services. Looking at the definition, it looks very wide. And then I should, one of the other conditions is I should be providing these services to a recipient in India. So this is also satisfied. So first question done and dusted. Let's move to second to see the further scopes of EL 2.0. Question number 2, ABC Private Limited, PTE Limited, a Singapore-based company, manages a digital platform which is into online gaming. So a Singapore company manages a digital platform which is into online gaming. ABC shares the data pertaining to Indian users who are resident in India to Dream21, another gaming company based out of Mauritius, for a sum of INR 20 crores. Determine whether equalization be triggered for ABC Singapore. Repeat the question again. ABC Private Limited is a Singapore-based company that manages a digital platform into online gaming. And that gaming platform has Indian users who are resident in India, sitting from India, who are playing those games. And now what ABC does, it gives the data of the Indian use. Now you know why they are asking for registration. Now the ABC PT Limited gives these data of Indian registered users playing the online gaming to another Mauritius-based gaming company called Dream21. So Dream21 asks ABC, can you please give me data of Indian registered users? Okay, happy to give. Pay me 20 crores, Indian rupee equivalent. The Mauritius company pays the Singapore company 20 crores. Determine whether equalization levy be triggered for ABC Singapore. So the first point we need to see is whether it's an e-commerce operator. Yes, I'm not going to go through it. It's very simple. Non-resident has a platform. Yes. Question number 2 comes into is it e-commerce supply or services? Now, so one could contend that yes, this is a service that is being provided by sale of data. Now the question is whether data is a good or selling data as a service. Nevertheless, there is a possibility that this may come as a provision of a service. Because again, as I told you, it is so widely worded. Online e-commerce supply means online sale of goods owned, online provision of services. So one could easily contend that this is nothing but a service being provided. What is the service being provided? Service being data being shared. Have a data, and I'm selling those data, sharing those data. So there is a possibility that services are being rendered. So because of the wide nature of how goods and services are. The next question is to whom it is provided or made. This is not made to a person resident or this is made to a Mauritius company. So can I now say equalization levy won't attract? Now let's look at this. Let's go back to the charging section 165A. It says the supply or services should be made or provided or facilitated to a person resident in India, or this is very important, or to a non-resident. So a non-resident to a non-resident possible in the specified circumstances as provided below. Now, what are those specified circumstances? Specified circumstances is given in the same section 165A. It says sale of advertisement which targets a customer who access the advertisement, and sale of data collected from a person who is resident in India or from a person who uses internet protocol address in India. So therefore, what is a specified circumstances? Non-resident, where there is a sale of advertisement which targets a customer who is resident in India or who accesses the advertisement, and sale of data collected from a person who is resident in India or from a person who uses internet protocol address located in India. So there are twin conditions to be satisfied. It's not only about sale of data collected from a person who is resident in India. There should also be a sale of advertisement which targets a customer who is resident in India. So we are not sure that whether the non-resident, that is, in our case, he has sold the data, there is no doubt about it, but whether there is a sale of advertisement which, so probably the government wanted to keep it as or, I don't know, but they have instead worded it as and. So which means both the conditions have to be satisfied. So one can take a call that when it's non-resident to non-resident, it is only when there is specified circumstances mentioned in section 165A. Specified circumstances. 1, there should be a sale of advertisement and sale of data. I believe it should actually be or, but the wordings is such that it says and. So because twin conditions have to be satisfied, no equalization levy for ABC Singapore. So if the question also says ABC Private Limited targets customers and also gives ads, but that's not given, so therefore it is not taxable. So this is question number 2. Let's move to question number 3. Tesla, a US-based electric car company, wants to enter into Indian market as part of its pre-entry strategy into India. Nestle approaches Facepalm USA to advertise Tesla cars to persons who are resident in India and in the age group of 30 to 50 years. I missed this part. Further, Facepalm will also share the data as to how many users click the advertisement and from which location in India and the age group. So for this, Facepalm USA charges $10 lakh to Tesla USA. Whether this transaction amounts to equalization levy for Facepalm USA. So I repeat, Tesla, a US-based electric car company, wants to enter into Indian market as part of its pre-entry strategy. Wants to enter into Indian market. So as part of its pre-entry strategy, it approaches Facepalm USA, social media company, to advertise Tesla cars to persons who are resident in India and in the age group of 30 to 50 years. So it gives instructions that advertise to all your users who are in the age group of 30 to 50 years. As part of this, Facepalm will also share the data as to how many users click the advertisement and from which location in India and their age group as well. For this, Facepalm USA charges $10 lakh to Mesla USA. Whether this amounts to equalization levy for Facepalm USA. So same, whether is it an e-commerce operator, Facepalm, yes, it operates, manages a website, so it is, and it's a non-resident, so it is an e-commerce operator. Facepalm is a non-NR. NR e-commerce operator. Now, whether is it providing e-commerce supply of services? Yes, we can say provision of services. So again, I just want to show how exhaustive e-commerce supply of services can be. Yes, it's a clear case of provision of services. Now, question is NR to NR specified circumstances. If you recollect, if I'm going to make this service to a resident in India, not a problem, straight away tax, because this is Mesla USA. Mesla USA is the recipient, which is also a non-resident. So non-resident to non-resident means it has to be under to a non-resident in the specified circumstances. So what is the specified circumstances? Sale of advertisement which targets a customer who is resident in India, or a customer who accesses the advertisement through internet protocol address in India, and sale of data collected from person who is a resident in India. So both these conditions are satisfied. Facepalm sells advertisement. Sale of advertisement is a very bad drafting. Ideally, you cannot sell an advertisement. Maybe it's like display or provision of advertisement services or online advertisement. And sale of data, which is also what Facepalm is doing. It not only gives advertisement, it also sells data that it has collected from Indian residents. Say, you look, take it to Mesla. There are 10 lakh users who clicked. Out of these 10 lakh, 5 lakhs from South India, 3 lakhs from Western India, 2 lakhs from other part of India. This is the age group, this is the demography. So all these details will be given to Mesla. So that way Mesla will plan its strategy further. So this is a clear case of NR recipient. NR to NR will cover because under specified circumstances. So therefore, this is definitely equalization levy, EL attracted for Facepalm. So this is exactly what India is trying to do here. To target these big digital giants. Now let's look at question number 4. Mr. Ramesh, a Chennai resident, goes to France on an official trip. This particular question I wanted to showcase how wide the scope is. Mr. Ramesh, a Chennai resident, goes to France on an official trip, and during his stay at Paris, Mr. Ramesh, through his computer, which is connected to an India VPN, that is, the IP address is located in India, he orders from a French e-commerce platform luxury goods for a sum of rupees 3 crores, which were delivered to his Paris hotel. Determine whether equalization levy will attract for the French e-commerce operator. Now look at here, Ramesh is an Indian resident, goes to France on an official trip. During his stay at Paris, he orders luxury goods from a French e-commerce platform for amounting to 3 crores, say Louis Vuitton bags, for belt, whatever accessories, and it gets delivered to his Paris hotel. So question is whether equalization levy will be attracted. Again, the process, the steps, whether is it an e-commerce operator? Yes, non-resident e-commerce operator, because the French maintains a website. So Okay. Whether it is e-com, supply or services, again, as you have already seen, either own goods or even if I facilitate sale of goods, so yes, we'll get definition triggered. Is it provided? Now the question to whom it is provided. So specified recipient or buyer, whatever. That's what the section says. So who are the specified buyers? He should be a person resident in India. Now, even though the question mentions is from Chennai, what if he doesn't become a tax resident in India? So very difficult to contend this. To a non-resident in specified, no. At least we can say that again. Very difficult to say that it's a non-resident. And again, it has to be in specified circumstances, which is sale of data and online. That's not happening. So this is ruled out. Second is ruled out. Now there's one more category of buyer. To a person who buys such goods or services or both using internet protocol address located in India. So the government is getting very, very conservative at the same time making the scope very wide. If you are a resident and you're availing services from or buying from a non-resident e-commerce operator, attracted straight away. To a non-resident under specified circumstances, we saw what are those specified circumstances, that is online advertisement and sale of data. Going further, they're also saying to a person who buys such goods or services using internet protocol address located in India. So if the internet protocol address is located in India and that person buys from the non-resident e-commerce operator, then it will attract. So in our question, yes, to specify the person buys from an IP, buys person whose IP is located in India. Therefore, for the French e-commerce operator, the EL is levied. Because if the provider is the recipient, is anyone who is using IP address in India to buy such goods or services, then in such a situation, it will be applicable. So we saw these three situations: non-resident in India, and if the buyer is a non-resident, and the specified circumstances where there is sale of advertisement and data, and for anyone, whether you're a resident or non-resident, doesn't matter. If you're using IP address in India to buy goods or services from the non-resident e-commerce operator, then in such a situation, equalization levy will be triggered. So therefore, very, very expansive. This is precisely what I wanted to highlight and touch upon. I hope it's clear as of now. One final variant, which will give the wider scope again of attractability of equalization levy. Let's go to question number 5. As a Squid India is into manufacture of drones and is a subsidiary of Squid South Korea. Squid India identifies Indian customers and finalizes the contract independently. So it's a subsidiary which goes, finds customers in India and finalizes the contract. On completion of the contract, Squid India will have to place the purchase order of the drones from the internal website maintained by its parent in South Korea. The portal is maintained in the parent level to enable proper inventory records. Will this amount to equalization levy for Squid South Korea? I repeat, Squid India is into manufacture of drones and is a subsidiary of a Squid South Korea. Squid India finds Indian customers, finalizes the contract, everything independently. On completion of the contract, Squid India, because of digitalization, ERP, etc., this is very common in multinational enterprises. Squid India will place the purchase orders of the drones from the internal website maintained by its parent. So that way there is proper maintenance of inventory and it will be easy to take stock, everything. The portal is maintained in the Korean level, being the parent. Will this amount to equalization levy for Squid South Korea? So now we are concerned only about non-residents. So will this amount to EL for Squid South Korea? Let's go through the process. First, is it an e-commerce operator? Should be a non-resident who owns a platform or a facility, electronic facility, which is yes, satisfied. So Squid is a non-resident e-commerce operator. Does it provide e-commerce supply or services? The question. Online sale of goods, online provision of services. Now, what the government has done in 2021, very interestingly, with retrospective amendment from 2020, explanation. So this is basically we saw what is an e-commerce supply or services, online sale of goods owned or facilitated. So this was how 164 CB was. But explanation was added by Finance Act 2021 with retrospective effect from assessment year 2021. Clarifies that following online activities shall be included in the definition of online sale of goods and online. So the following any of these activities will be included in the definition of online sale of goods. Any one, what is it? Acceptance of an offer for sale, placing of purchase order, acceptance of the purchase order, payment of consideration, and supply of goods or provisions. So any of these things, even one happens, not cumulative. Any one is enough. Any one happens, then it will be included in the definition of online sale of goods or online provision of services. In our case, what is happening? Placing of purchasing order is happening, and acceptance of the purchase order may also happen. So therefore, this will amount to online sale of goods facilitated by the e-commerce operator. This is huge. Now, why I wanted so clearly satisfied, but now why this is huge is this is not digital economy. We are talking about digitalized economy. Talking about manufacture of drones. These are not your GAFAs, Google, Apple, Facebook, Amazon. These are your proper manufacturing companies. So they only digitalized, which is very common nowadays. Like this training, the learning hub, everything is getting digitalized. It's a difference between digital and digitalized. But the definition is so wide, explanation to section 164 CB introduced with effect from assessment year 2020. But this was introduced in FA 2021, but with retrospective effect. With retrospective effect from assessment year 2020-2021. It's very important. This has very far-reaching implications. So therefore, this will be e-commerce supplier services. And who is the buyer or recipient? It is a person resident in India. So EL will apply for Squid South Korea at 2% on the consideration. So we have looked into who should be an e-commerce operator, what is an e-commerce supplier services, very widely worded, online sale of goods, online provisional services. And not only that, even if I make a purchase, accept a purchase order, place purchase order, that will also amount to online sale of goods. And we also saw to whom should the services be made. If you look at Equalization Levy 1.0, it was very clear the service recipient should be a resident in India. But here, under Equalization 2.0, the service recipient can be need not necessarily only be a resident in India. It can also be a non-resident, where it involves sale of advertisement and data, and any person using IP address in India to buy goods or services. So any person, whether resident or non-resident, using IP address in India to buy goods or services will become a buyer or recipient. Accordingly, equalization levy will be attracted, and the non-resident e-commerce operator has to pay 2%. There is no need for the service recipient to withhold taxes. It is the non-resident e-commerce operator himself has to pay 2%. Now, let's quickly look at the exclusions. Is there any benefit, threshold, other aspects that I can get away from equalization levy? Let's see that. Question number 5. That should be question number 6. Here, facts are similar to question 1. This is the fact. XYZ Inc. operates and manages a website. Sales amounting to INR 5 crores. Facts are similar to question 1, except that instead of 5 crores, the sale is only 1 crore. So let's go to question number 1. This is nothing but a plain vanilla online sale of goods, children toys, to persons who are resident in India. The amount is INR 1 crore instead of 5 crores. Now, one exception you have in equalization levy is if the sales turnover or gross receipt is less than 2 crores. If it is less than 2 crores, then no equalization levy. Equalization levy is exempted up to INR 2 crores. So up to INR 2 crores, equalization levy is exempted. I don't need to worry about equalization levy. Now, the question number 7 is very similar to what we have already seen in equalization levy 1.0. If the non-resident has a P in India and if it is effectively connected to P in India, then equalization levy won't attract. So I'm not going to spend time on it. Very similar. Let's look at question 8. Facts are similar to question 3. That is the Mesla face palm case. So instead of Mesla US, Mesla India, let's assume Mesla India engages face palm India for sale of advertisement. So since this will come under equalization levy 1.0, you remember 1.0, where an Indian resident engages a non-resident for online advertisement, then in such a scenario, 6% will come. So if So first equalization levy 1.0, and then only you have to go to equalization levy 2.0. So if it's already covered under online sale of advertisement, then you don't need to again pay an additional 2%. So 6% will be enough. That is provided in this question. Is instead of MESLA USA, it is MESLA India. So equalization levy 1.0 will attract. If 1.0 comes, you don't need to go to 2.0. Now, this question, this is again similar to the question number 4. If you recollect, in what question number 4 says is, an Indian Chennai-based resident who goes to Paris and through IP address located, which is an IP address in India, he buys luxury goods in Paris. Whether it will come, we saw yes, equalization levy will come because IP address is located in India. Slight variation to this question. Instead of buying luxury goods, he buys Indian Tanjore painting. So in the French platform, e-commerce French platform, there is a resident, Indian tax resident buyer, Indian tax resident seller. Let's assume the e-commerce platform is a marketplace. There the resident, some Indian resident is selling Tanjore paintings or Indian art painting. Mr. Ramesh, who uses IP address, buys those Tanjore paintings in Paris. You may ask, why should he go to Paris and buy Indian painting? Maybe he wanted to gift to all his foreign friends, showcase Indian culture. That's immaterial to us. The point what I wanted to drive here is, in this foreign online e-commerce portal, a resident Indian is selling. So what the government says is, look, my idea itself is to ensure that the non-resident online e-commerce are getting caught. So if a resident uses a foreign platform to sell goods, then equalization levy won't attract, because there's another provision called section 194O, which will get attracted. So therefore, specifically an exemption is given whereby if the consideration is on account of sale of goods which are owned by a person resident in India. So the government, then in that case, they will use section 194O and they don't want to come under equalization levy. So that is the small aspect which I wanted to bring it. Don't we just have a look at the provisions again, you'll be in a position to understand. But all you need to remember fundamentally in equalization levy 2.0 is they are targeting non-resident e-commerce operator who provides e-commerce supply or services. Now, what is an e-commerce supply or services? Very, very exhaustive. Sale of goods, providing services, facilitation. And not only that, even if a place purchase order, all those things will come. And to whom should I provide? To a person resident in India, to a non-resident in certain specified circumstances, or to any person who buys such goods or services from the e-commerce platform using an IP address located in India. So all these are the final nuances to it. And please also watch out that there is a threshold of 2 crores. So if these conditions are satisfied, equalization levy will be attracted at 2% on the consideration. You can probably look at, there are some examples similar to what we did given in the material. Maybe we'll quickly run through this flowchart as a quick recap. Equalization levy on e-commerce supply of services, 2% of the amount of consideration received or receivable by an e-commerce operator. That is a non-resident who owns, operates or manages digital or electronic platform, and he gets this amount from e-commerce supply or services made or provided by it. What is an e-commerce supply? We've already seen this. To whom should these supply be provided? It should be to a non-resident in the following circumstances, specified circumstances. To any person resident in India, it will get triggered, or to a person who buys such goods or services using an internet protocol address located in India. So in such situations, equalization levy will be attracted at 2 crores. If the non-resident has a P in India, then in such a situation, equalization levy won't attract. Normally, an e-commerce of non-resident e-commerce operators won't have a P in India. So therefore, equalization will in major cases will get attracted. If equalization levy is attracted, then the e-commerce operator has to pay. There is no concept of deduction in equalization levy 2.0. The non-resident himself has to pay every quarterly, 30th June, 30th September. If he doesn't pay, simple interest and penalty. So therefore, the onus is on the non-resident e-commerce operator to pay. Now, one last aspect that you need to be aware is in the interplay of Income Tax Act versus Equalization Levy, especially Equalization Levy 2.0. Now, we have already seen Section 10, Clause 50, which is an exemption under the income tax. And if you pay Equalization Levy, you are exempted from Income Tax Act. Now, explanation 1 to Section 1050 was introduced. Now, I'll tell you why this was introduced. Take a look at this question. You will understand why that was introduced. Messrs. Up Academy, a Russian online educational portal, provides 100 hours exclusive training on artificial intelligence and blockchain for engineers of the Indian company. So there is a Russian online educational portal which provides 100 hours exclusive training on artificial intelligence and blockchain for engineers of the Indian company. In this regard, the Indian company provides INR 5 crores as consideration. The Indian company wants to know whether TDS needs to be deducted or equalization levy will be attracted. Why equalization levy? Because there is a non-resident who has an online educational portal. So he becomes an e-commerce operator. Is he providing e-commerce supply of services? Yes, he is providing online provision of services. That is training on AI and blockchain. To whom does he provide? He provides to a resident Indian. Therefore, equalization levy will be attracted at 2%. Now, the same transaction also gets attracted under section 917. That is fees for technical services. You all see 917. Any technical services payable to a non-resident, you don't need the services to be rendered in India. As long as they're utilized in India, FTS will attract. FTS rate, as you know, under the Income Tax Act 115 is 10%. Normally, all the Indian treaties also has a more or less same percentage, 10%. Nothing less than 10%. So imagine from an Indian government standpoint, Russia will be happy to invoke equalization levy, the Russian company, because only 2% equalization levy. But India will lose additional 8% because had it been an FTS under Income Tax Act, 10%. Why? 10 clause 50 says once equalization levy attracts, income tax exempted. Income tax should not come and trouble me. So therefore, what was happening was these non-resident online service providers were making use of equalization levy. So there was a tax arbitrage on the rate. So to stop doing that, explanation 1 to section 10 clause 50 was introduced to say that if there is royalty or FTS that is taxable under the Income Tax Act, then exemption won't attract. That is, if first you have to look whether it is royalty or FTS, and if it is taxable under the Income Tax Act, yes, then you don't need to go to equalization levy. If it is not taxable under the Act, then go to Act also includes treaty. If it is not taxable under the Income Tax Act, then go to equalization levy. This is only for royalty or fees for technical services. I repeat, if it is royalty or fees for technical services under the Income Tax Act, then equalization levy won't attract. If it is not royalty FTS, it is not taxable, then equalization levy will attract. So coming to this specific question here, this is a clear case of royalty FTS. This is a case of FTS under section 917, that is deemed FTS deemed to accrue or arise in India. So hence TDS under section 195 will attract. No equalization levy, because first step is to see whether it is taxable as royalty or FTS under the Income Tax Act. If yes, then taxable under the IT Act and no EL. If it is not taxable as royalty or FTS, then you have to go to equalization levy. So this was basically to ensure there is no tax arbitrage benefit being taken. So therefore, explanation 1 to section 1050 was introduced. Say, just because you pay EL doesn't mean that you're exempted in Income Tax Act. There's a small deviation to it. If it is royalty or FTS, then it will only be taxable. Similar exemption is provided in section 163 of the Finance Act. So the government's point is, if it is royalty or FTS under the IT Act, first IT Act will take precedence, only then equalization levy. So just to sum up again, Equalization Levy 1.0 is for online advertisement by non-residents, 6%, and the consideration has to be withheld by the deducted by the resident service recipient. Equalization Levy 2.0 is for non-resident e-commerce operators providing e-commerce supply or services to a resident in India, to a non-resident in India under specified circumstances, and to any person who is buying online sale of goods or professional services using IP address located in India. In such situations, the non-resident e-commerce operator will have to pay on his own 2% of the consideration, 2% on the income that he has received. The only benefit in EL 2.0 for non-resident is there is a threshold of 2 crores. If the consideration received from the specified buyers or recipients don't cross 2 crores, then there is no equalization levy triggering in India. So this concludes equalization levy coming as part of the Finance Act, and I would strongly suggest you to have a look at the illustrations questions, which is more or less similar to whatever we have discussed in the practice questions which I had. You can have a look at it during the weekend. So this will strengthen your equalization levy concepts. Now, I want to tell you this. Is this a long-term solution? Will this work? Because 2% of consideration, 6% on consideration, and over and above, it is not part of tax treaties. Do you think other countries will agree? Is this the right way to go about going with unilateral measures? These are larger questions not relevant for your exam, but I just want to tell as part of overall understanding. As I mentioned to you, the idea was basically to bring countries, larger digital countries, into the negotiation table. So the equalization levy will be abolished once there is a consensus amongst countries as to how to tax these digital companies, which does not have a fee. So countries are discussing. I'm sure you will get to know that once you become chartered accountants, because by 2024, they're hoping that they'll come to a solution. Already there are a lot of draft papers going on, consultations are going on as to how to ensure that market economies like India gets its share. So there is a possibility in 2-3 years down the line, equalization levy will be abolished. Why I mentioned this was the fundamental principle in order to tax a foreign company in India is it should have a permanent establishment. And since these digital companies don't have a PE in India, and the tax treaties are also not updated because these were treaties that were entered in a pre-digital era. So they were taking benefits, say, treaty does not talk about virtual PEs. So therefore, there is no PE in India, nothing is taxable. So what India has done is just there are countries with which there are no tax treaties. For example, Bahrain, Azerbaijan. Small countries, not even relevant. But anyways, India does not have a tax treaty with them. So if at all there is a Bahrain digital giant, so India introduced this virtual PE concept called the significant economic presence. So just be aware about this. This was inserted and applicable from Finance Act, from assessment year 22-23 for your exams for those who are taking up, because these were notified only in 2021. This is mainly relevant for non-residents with whom we do not have a treaty. Because for non-residents, there's no treaty, then only I have Income Tax Act to look into it. I don't need to worry about treaty. So what India has done is India introduced a concept called a virtual PE, called the significant economic presence. That is, you don't need to have an office, you don't need to have a warehouse, you don't need to have a branch. But virtual PE says, if a non-resident does any transaction with a person in India, any transaction, online transaction with a person in India exceeding INR 2 crores, then there is a business connection for the non-resident. Repeat, a non-resident who does transaction with a person in India, exceeding INR 2 crores, then for the non-resident, there is a PE or a business connection created. So this is one aspect to the virtual PE, or the India calls it as a significant economic presence, transaction based. Alternatively, I may not have any transaction, but if I systematically and continuously solicit business, this is basically for digital companies, by engaging in interaction with users, say like Facebook, Twitter, Snapchat, systematically Instagram, continuously soliciting of business activities or engaging in interaction with users in India more than 3 lakhs. 3 lakhs is nothing. Not even one part of, I mean, a small, one small residential township in 2-3 spaces, Bombay, you will cost 3 lakhs of users. Anyway, the point India wants to say is, if these non-residents who are having 3 lakhs of users, more than 3 lakhs, and any non-resident who is doing a transaction with a person in India more than 2 crores, then India says there is a virtual PE. Otherwise, India calls it as significant economic presence in India. So under the Income Tax Act, there is a business connection triggered. So this was introduced basically to counter the digital companies, because these digital companies need not have any physical presence in India because of the fourth industrial revolution we are in. So that's why India introduced the concept called SEP, which is almost like a virtual PE. You do transaction with any person in India more than 2 crores, or I don't do any transaction, but I have a social media or I have digital interaction with users. There are more than 3 lakhs users in India, and that company will have a significant economic presence in India. Okay, what will happen? Then in that scenario, whatever profits they are making globally, they have to attribute certain profits that is relating to India market, and then pay taxes on it at 40%. So this is India's response saying, look, supply, you have to give to the supply economy as well. It's not only about supply, it's also demand. The demand comes from India. So India should also get its fair share of the taxes. And that's how the concept of SEP. Now, similar such provision is what they are trying to invoke in tax treaties also. So once a similar kind of a virtual PE kind of situation comes in tax treaties, it will be easy to invoke. At the moment, we do not have something similar to explanation 2A in tax treaty. So therefore, none of the non-residents are ready to pay tax in India, because they are saying, I do not have a permanent establishment in India. I am not doing business in India. I am only doing business with India. So that's why India had to introduce something called Equalization Levy. So with this, I will stop. So please be aware about SEP, significant economic presence, the threshold value. This is basically nothing but a virtual business connection or a virtual PE. And we looked at Equalization Levy. The Equalization Levy is part of Finance Act, basically targeting non-resident online advertisement companies and non-resident e-commerce operators. I will stop screen here and happy to take questions. Sumit, I think I've answered your question. In future, this equalization levy could be area of practice. Already an area of practice, but by the I told you maybe another 1 or 2 years after that, equalization levy won't be there. But there's a lot of scope because there's a lot of talks going on as to how to attribute profits. So this is exactly the issue that's going on at the global level. How to attribute the profits of a digital companies into market economies, because all these digital companies are invariably US and Chinese companies, big companies. So if India wants, South Africa wants, Brazil wants, European countries want, how will you allocate profit? So it will be very interesting in the future. And now it has become more political also, so that's why it become very exciting. Because as I told you, no country wants to give its share of taxes to other country. But that's when diplomacy and all those things will come and we need to find out how to do it. But yes, this taxation of digital economy is going to be a great area of practice. Again, because of crypto, metaverse, very difficult to identify where the nexus is. So it's going to be becoming it's going to become very challenging. If advertisement for donation by NGO, will it come under equalization? Yes, any person resident in India. Even if an NGO, no, but see, NGO should be doing business in India. If you look at Equalization Levy 1.0, the question is the person resident in India who should be doing business will be very clearly mentioned in Equalization Levy 165. Yeah, look, good question, Namita. If you see 165.1, Equalization Levy for consideration relating to online advertisement by a person resident in India carrying on business or profession. So online advertisement services availed by a resident in India, he should be carrying on business or profession. But please understand, this condition is not there for Equalization Levy 2.0. Equalization Levy 2.0, any person resident, whether they're doing business or not, immaterial. So watch out for the subtle difference. The idea is 165A, that is Equalization Levy 2.0, is they want to target the non-resident e-commerce operators because they're invariably serving the B2C market. I go buy from Amazon platform, I directly engage Uber. So they're targeting the non-resident e-commerce operators. Okay. I mean, good question. The EL versus income tax, if it was recorded lectures. See, that's a very, these are some of the nuances you get it, because if it's a recorded lecture, it's not an issue. If it is a general lecture, say, let's assume I engage an online Coursera or any other non-resident provider where I want to know how to have a dining etiquette globally. It doesn't cater to any specific aspect. So question is, will it amount to services or is it just a facility? So in that case, you can get away saying it's not a fees for technical services. Equalization levy will attack. That's why in my question, I specifically mentioned this is a customized training on artificial intelligence blockchain because I wanted to differentiate between income tax and EL. But if it is just a facility, it's just that anybody can do a taxes, ready-made stuff, then more likely it will be equalization levy. A good point, Naveen. Will franchisee like KFC be considered P? No, not necessarily. Because franchisees are only taking the brand for which they pay royalty on the sales. So when will a PE come? A PE will come, as I mentioned to you, when the foreign company has a virtual projection, alter ego. That is, tomorrow, it's like my office. I may be headquartered in Paris, US, but if I have a PE in India, I can come anytime, I can go anytime. Disposal. The office disposal, the permanent establishment disposal is one of the major criteria. The disposal should be at the hands of the foreign company. In franchisee business, I may be the owner of KFC brand. I would have given a franchisee to, say, somebody in India, Bombay, who will be a master franchisee. That's it. I cannot just like enter his store whenever I want, sleep, lock it. I cannot do that. So franchisees won't become PE. PE, you should understand as if I have a complete control, where the office is, the permanent establishment is in my control, duration, disposal, just like how it is my office. Today I have an office in Chennai and I have an office in your place. I'll say it's my office. I can come anytime, I can go anytime. You give the lock and key to me, then it's a PE for me. But if I say, Naveen, can I come to your place and then stay, ask permission, then it's not a PE. Yes, yes. Yes, Namita, they have to do it. So please watch out for Equalization Levy and the SCP. 5 to 8 marks in easy marks for taking. Just understand the concepts and fundamentals. After that, it's just quite easy. So thank you very much. And if there are any further questions, you may please feel free to reach out to me. Share my email ID. Why I'm not able to share? Okay, my email ID is sudarshan@inbox.com. Anyway, I'll be uploading the PDF of the slide decks that I've used. So you may reach out to me for any further questions. So thank you very much. I really enjoyed the conversations I had with you. Thank you for all the questions and best wishes for the exam. And have a good weekend. Please ensure that you go through Equalization Levy in SCP and the double tax over the weekend, so that this concept will get ingrained and you don't need to worry at the time of exams. It'll be easy for you to remember the concept when you do a refresh or do a revision. So thank you very much. Thank you. Good night. Take care. Bye.